RBC Capital's Jonathan Golub is even more bullish. His year-end target for the index is 2,325, a gain of some 13%. John is here with us this morning. Jonathan, you have been rewarded for your bullishness, and you expect to be rewarded again.
Yeah, this past year we were expecting 2075. We're a little bit less than 1%. Too optimistic on that number, basically on the target, and we think it's going to be another good year.
Now, 2075, that was a revision, though, because you didn't start the year out that
so
bullish.
it was January 6th. We put the number out at 2075, so we were there all year long.
Pretty much.
Pretty much. So we missed the first day.
Okay, so a forecast, right, has two components. You've got earnings.
Right.
So you add up what you expect all of those S&P 500 companies to earn, and you come up with a per-share figure. And then you have the multiple. Now, what surprised everybody this year, and I think to a degree surprised you a little bit, is how much investors were willing to pay for earnings.
Yeah, I mean, one of the things that we've been saying, really for the last several years is that because interest rates are so low and stocks look so attractive compared to bonds, we're going to see valuations continue to rise. And so we actually were forecasting that we'd end the year with a 16 PE, basically paying 16 times a year's worth of earnings at the end of the year, which is kind of where we are now, and that on a forward basis.
Okay.
And we're expecting the year to end up almost 17 times forward at the end of this year. So we expect multiples to keep going higher, and really there's two key drivers. One is U.S. stocks look much more attractive than global alternatives, and number two is that interest rates being low makes the value of a cash flow more, and therefore stock valuations go higher.
Should people care at all what the valuation is relative to trailing earnings? Because if you look at it on that basis, the S&P 500 is trading roughly at 18.2 times,
right,
which on a historical basis seems a little rich.
Maybe you could. Frankly, you could do the work either way. When we've modeled it both ways, you get a slightly better reading. I mean, you're buying future cash flows. You're not buying
Sure,
what a company
you're not buying
earned.
Historical cash
and
flows.
so therefore, it would kind of make logical sense, and you get a slightly better reading if you're doing it that way. But here's the key: is that valuations, PEs, are like a pendulum. They've gone as low as 6 and as high as 24. So to be at 16 or 14, you're kind of in the middle. It appears to be where the pendulum is swinging that's more important. When you're going from very low, which we were 5 years ago, towards something which is higher, this tend to continue as long as the economy stays away from a recession, and we don't think we have one coming up.
To that point, there's an upside and downside risk to both elements or both variables in that equation.
Sure.
Where do you think there's more? In the performance of companies and the profits that they generate, or the valuation that investors are willing to apply to these stocks?
If you ask me, if we broke it to your point, earnings versus valuations, I think there's upside risk on the valuations, and people don't think people can pay more for the stocks, but I think they will. I think there may be downside risk on the earnings.
Why?
If there was. Well, I mean,
because you're pretty bullish when it comes to earnings. You're looking for what
a little under 8% earnings growth. So if I'm looking at about 13%, I'm expecting 5 to come from PEs and 8 to come from earnings. The argument that people have been making against earnings, which is not one that I agree with, is that margins are really high, and part of the reason is because companies are doing a brilliant job of managing expenses, but there's always a question, how much more can you squeeze out on the margin side? I think the answer is in a year from now, we'll see margins incrementally higher, maybe 1% higher. I mean, really small number, but a little bit higher. But that's been the area that investors have had a harder time getting their hands around.
They've had a harder time getting their hands around it, but productivity and margins continue to defy expectations.
They do, and it's not that companies.
Obviously, trees can't grow to the sky.
They can't, but I mean, margins on the S&P are about 10%. So I'm not saying they're going to go to 12. I'm just going to say they're going to go from 10 to 10.1, or 10.2. I mean, those are baby little incremental increases, and that's all you need to get a 1% additional increase on your earnings number.
Jonathan, before we run out of time, we need to talk about central bank policy.
Yes.
The Fed is unwinding. Well, QE is over, effectively. And at some point in the next 6 months to a year, the Federal Reserve is likely to raise interest rates. At the same time, some perhaps more important things are beginning to happen overseas, right? Today, in Handelsblatt, the German newspaper, Mario Draghi wrote, and I'm going to quote him directly, "We are in technical preparations to alter the size, speed, and composition of our measures at the beginning of 2015, should this become necessary to react to a too long period of low inflation. There's unanimity in the ECB Council on that. We can debate the whole unanimity issue, but what he appears to be doing is foaming the runway for the European Central Bank to start quantitative easing.
I mean, the reason I'm smiling and laughing is that Mario Draghi has been saying something which looks almost like this for 2.5 years.
But he hasn't been saying it to the Germans directly through one of their most important newspapers.
Right. I mean, here's I think the important thing that's going to happen with the Fed when they finally raise rates. And whether it's in June or December, you can't have zero rate policy forever. And the U.S. economy is, while it may not be, pumping at 3.5%, it's moving ahead in a strong enough way. We don't need zero rate policy. If you look at the last 2 times that the Fed started a cycle of rising rates, stocks have gone up for 2 years after their first move. And even if they started in, let's say, September of next year, you're talking about several more years of potentially good stock markets.
So how is quantitative easing in Europe and also the quantitative easing that's underway in Japan going to influence the situation, at the very least here? You've got I saw a calculation this morning that between the ECB and the BOJ, they would be pumping collectively $100 billion a month into
it's a lot. It's a lot of liquidity.
More than the $85 billion that we saw at the peak of QE.
So here's what's likely happen. You see that the euro, if that were to occur, the euro weakens further, the yen weakens further, the dollar strengthens, and what investors want to do is they want to get into the U.S. market so they could take advantage of not only the S&P being on a stronger economy, but also the fact that they participate in a rising currency, and that pushes valuations higher. And so, in fact, this may be better for U.S. stocks than it would be even European stocks.
Imagine that. Jonathan, thanks so much. Great seeing you as well, as always. Jonathan Golub of RBC Capital Markets.